Hey, good day, everyone. Deribit live, December 21st. It's almost the shortest day. I think tomorrow is technically the winter solstice, the shortest day of the year, but pretty darn close. And our last broadcast before Christmas, for those who celebrate Christmas. Good times, good times. Lots of interesting things happening in the market, as we knew would be the case. We've been talking about the last, last month, really. First off, can everyone hear me okay? Andre from the Netherlands, good. I assume you can hear me, otherwise you'd probably be like, we can't hear you. All right, let me just do a couple of little housekeeping items here.
Winter solstice tomorrow morning, 4 a.m.
Tomorrow morning at 4 a.m.
That's at least here where we are. Because it's different for each location.
Yes, indeed. Okay. And Andre, anyone out there, just let me make sure if you can hear me. Just let me know. And I'll finish my housekeeping items before we move on to the good stuff. We've got a little bit of action happening right now, actually. So. The market's threatening a little bit, which we'll look at in a moment, which it tends to do. So we'll see what happens. The U.S. opens up in about 30 minutes officially. Futures are pointed up over there. We'll talk about all that good stuff. Yep. Antoine says, all good. All right. Excellent. Ola from Algarve. Oh, that's Andre, the other Andre. A lot of Andres in the world. All right. Okay, so we'll wait a few more people rolling in here. I imagine we'll probably have a pretty light turnout, considering it's right before the holidays, and a lot of people have already checked out and they're off doing their family things and holidays, whatever they're going to do. But that's okay. The market stops for no one, at least the crypto market. Other markets do. And that's a little bit of a danger, actually, because, we've talked a lot about, this is going to happen over the holidays. That's going to happen over the holidays because we've been, programmed for 25 years trading these traditional markets, which just close. And there's literally nothing that can happen. But shenanigans could ensue in the crypto market because, number one, it doesn't take a lot of, the same size of a whale to move the market as it was the S&P, for example. And you know what? When North America sleeps or is on holidays for 4 or 5 days, you can get some, I'm not going to call them shady characters, but some characters, maybe playing around, pushing the price around, causing some stops to get triggered and whatnot. So who knows what will happen over the holidays. All right, let me get on with it here. I'll stop babbling.
We need some the American Navy to go over and bring some freedom to people doing shenanigans.
Yes, I have no comment on that. All right. What's on the agenda today? Oh, look, I even updated the agenda. Although I got a small dot here. I don't know how that happened. Anyways, the topic today, and this is actually very, very, very important, and it's something we literally do every time we make trading decisions. We take this into consideration. Smearing options. Now, I don't know if Richard coined the term smearing. Now, I just use it all the time. He's called that. Maybe somebody else did. I don't know. Did you make that up, or do you think you made that up?
I'm told I coined it, yeah, but I'm sure other people have done so in the past.
All right. Well, we'll get into what smearing options is and reducing concentrations of risk and how it is going to make your life one hell of a lot easier, sleep a little better at night, and smooth out your trading in a lot of different ways. And before I get started, hey, check out in the chat. There's a link there. If you don't have a Deribit account, click on that link, save 10%. Do us a solid in the meantime. Deribit, of course, is the place to be for retail option traders. And hey, if you want to follow us and hang out with us more often than just once a week, roguetrader.academy. Join, for example, silver and higher. You get to hang out in our silver, our live alerts, interactive live alerts channel where we post our discretionary trades and people can ask questions in chat. We'll have a weekly Ask Me Anything call in the recordings. Get access to all our educational content and courses we publish. We try and publish one every 3 or 4 months. And you get access to our daily live stream. We trade a fund. We set up a little Bitcoin options fund on the Zigdao platform. We trade it through the Deribit interface. And we set that up with 5K just to kind of show some of the techniques we do, not all of them, for larger accounts on a smaller retail size account. Or if you just want to, see the live stream, you can do so at patreon.com and OnlyFans coming soon. Excuse me. So that is our plug. Let me stop this and go over to our charts. You know what I want to do, Richard? I wanted to use the drawing tool again but the last times we used it a few months ago, it kind of crapped out on us. It didn't work, and then we couldn't do anything, and so I've avoided it. But anyways, Let's start off with ETH. ETH is like Charles Dickens' novel here. It's sort of the red-headed bastard child. It's not doing what it's supposed to. It's underperforming. It's kind of the lame duck, right? It's just sort of doing its thing. It's not really doing a lot. I don't have any trades on in ETH. And I think it's probably a pretty tough thing to trade right now.
I would imagine that people are waiting to see whether the Bitcoin ETFs go through, and then later on there'll be applications for ETH ETFs. So I think right now it's just that it's not in the limelight, right?
Yeah, I'm sure it's the stepchild out on the curb, and it's waiting for its big brother to do whatever it's going to do. I don't know. There's some sort of a simile there or a metaphor I could use, but I can't think of one off the top of my head. ETH's a little bit dull. I think it's a tough, choppy trading. It is formed a bit of a sideways channel, as we'd expect, following loosely in Bitcoin's footsteps, but we're still a long ways away from my unicorns. My unicorns are kind of up here in the high 2000s and down here in the mid 1000s. I don't expect those to do anything anytime soon unless Bitcoin does something crazy, and it might. So if you all remember, for anyone who's on the call in the last 2 or 3 weeks, basically since the beginning of December, maybe the first week of December, we had this big move up. We hit 44,000 basically, farted around. We came down, went down to about 41. And I said, this is going to be a channel. This is going to be a channel probably for the rest of the month. And the smart thing to do would probably be to put on an iron condor, or maybe the smarter thing to do, which is what we tend to do. I don't usually just throw on an iron condor unless it's really short dated for any old reason, is sell spreads on each side. So every time we go up, maybe we'll sell some call spreads up here. We go down, we'll sell some put spreads down here. Get better prices for them, right? That's what I prefer to do, and that's exactly what has happened. We've gone down to 41,000 a few times, and look, we've come up to 44 a few times, and right now it's kind of threatening at it. If it's going to go, I don't know. I don't think so, but it could. It could. It's super volatile. It's super sensitive to news. We've got the U.S. opening in 20 minutes. U.S. futures are pointed up after a big down day yesterday. There's so much, if anyone follows those markets, there's been so much euphoria, just high after high after high. So it was due for a correction. So I don't think it's anything bizarre. But if the U.S. shoots up today, is it going to pull Bitcoin along? No, maybe. We'll see. But I think the smart trade right through the end of December was probably to sell those spreads on each side of that channel. Now, of course, we have to wonder, this movement is people, of course, jumping the gun. Everybody's like, okay, well, the ETFs are coming out, right? The ETFs are coming out in January, 90% or whatever those odds happen to be. So everybody wants to get on board earlier. Okay, I understand that. That's what this whole trend up was. People starting to accumulate for the most part. This is going to lead me to my poll, which I'm going to publish right now. Do you think that we're going to remain in this 41 to 44,000 channel until the end of December? Or do you think we're going to be jumping? People are going to be jumping on it to buy or to sell. Now, a lot of people think that we've got a gap to fill in the bottom. way down in the 30s. A lot of people think maybe the price is already factored in for this ETF thing. Maybe this is as high as it's going to go. Maybe, who knows? Other people think this thing's going to the moon, and there's always that camp, especially in crypto. So let me know what you guys think. If we're going to stay in this channel, or if we're going up, we're going down by the end of December. It'll be interesting to see what you think. In terms of where we go after this and what I'm planning, well, we can see this trend line down below that it was extended. So, by the time we come down, if we came down and meet it 41, it means we kind of hold the range still. If we break down, why not go to mid 35,000, 36,000, 37,000? You can do that in a heartbeat, even if it just did a quick little move down and came back up. A lot of people are calling for low 30s as a full retracement. In fact, might happen. Who knows? I think that overall would be net buyers if we dip down through the 30s. Rich and I have sort of discussed this, and we thought, probably accumulating at that point and probably selling spreads. And if we have to roll them down, no big deal. We're pretty happy to do that. But let me just go from a 4-hour to a daily chart, because and just before I do that, we've got this little white gap here. It's like, what the hell is that, Shane? Well, these gaps are these vacuums, right? Markets, nature abhors a vacuum. Maybe unless it's a Hoover, I don't know, but nature generally abhors a vacuum. And prices won't stick in there. I don't trade in vacuums. I'll trade on the other side of the vacuum. But how did this, and this is kind of like not really a super strong, and it's not a super big gap either, really. But if we go to a daily chart and we look backwards to the left, you'll see where this came from. It's no big mystery. We were stuck there. We stuck, bonked its head, bonked it, broke through, came back down, bonk, it's down. So we ended up with this area. Now, I drew this, I think, at the beginning of the summer and the spring. Like, this has been here forever, okay? Then we got a bit of a space. We got this bit of a space here. Doesn't mean it's going to blast through it, but I think it probably will, before we come to the next place where prices were sticking. Prices hit its head. And that's why I'm thinking, 46 and a half, 47, 47 and a half. It'll probably be as far as it's going to go. If this busts 44,000 right now, and boom, we go on a tear, it's probably going to slow down at least, or stop around there. Or if it wicks through, it'll probably come back to it. That's why if we do get into this pink zone up here, I'm perfectly happy to sell 1 week, 2 week, maybe 3 weeks, just depending on the price action up here at the unicorn, deep into the 50s. That's where that came from, and that's how I lean on those things. And more, these are just, you sit back and you squint your eyes and you're like, okay. And that's how I trade options. I'm not looking for exact pinpoint edges. I'm not scalping the damn thing. We're selling options. We want to be in a nice, comfortable area where we feel safe behind support or resistance. So that's all I got to say about this chart. So far, the poll results are saying that most people think we're going to go sideways, which is quite interesting. But I'll let this poll run until the end of the call, and then I'll publish the results. So next thing up, let's talk about this whole idea of smearing options. And smearing options simply means, so imagine you've got a big glob of options. Here's your glob. We smear it like a bug on a windshield. That's how we trade. Bugs on windshields. There's a joke in there, because you know what the last thing a bug sees before it hits you? No, I'm not going to say that. We could have kids on the show. But basically, all we're doing is we're spreading those strikes out and or expiries out. So let's say we're selling the December 29, and we're selling calls, and we've got a call at 50,000 or 0.1 or 0.5 or whatever it happens to be. Maybe we've got one at 52. Maybe we've got one at 55. We've smeared them out. We're not concentrating all that risk on 50,000. And we might have a January 5. We might have a January 12th. Maybe we'll make a little bit more money. Maybe we'll make a little bit less money on them. But it's better to have everything spread out, because how many times have we been in a situation where, let's say you've sold the 50,000 call, and here comes the price barreling towards you, and you have to make that decision to roll the damn thing out, or out and up. So you make the decision, you roll the trade, and of course, as soon as you do, boop, it drops right back down to 47. And you're like, oh, I didn't need to do that. Now I've got to wait another 2 weeks or whatever for this value to come back to me. It's really annoying as hell. Well, if you've smeared those strikes, you've got 50, 51, 53, 55. Well, sure, you roll the 50. Sure, stay safe. But you didn't have to roll the other ones, right? Those are still going to come in at that same rate of decay or in that same time frame. So that's sort of the general idea of rolling, of avoiding those concentrations of risks and smearing the options, and of course smearing the expiries is a nice thing too as well. Because the more time you have, the less panicked you get about it, because more time for it to go your way. So, Richard, what are your thoughts on?
Yeah, I was just saying, I agree. It also works if you're hedging with futures as well, because you start feeding your hedge much more gently. So you have to commit less. You commit earlier, but you commit less. And so if you start to delta hedge the bottom of your smear, and it's wrong, then you're only wrong by 1/3 of the contracts or 1/5 of the contracts. If it keeps on going up and you start increasing your hedge because you now want to start hedging the second in the ladder, then you're a bit more committed, but you've had more time to get committed. And I find that for myself, it makes for much more less pressured decision making, and therefore more rational decision making, because you're only having to consider sort of 1/4 or 1/3 or 1/5 of your risk in that month at a time.
One thing I'll mention is a lot of this, I've done this. I don't do it anymore, but I've done this. I'll see people, let's say they're trading the December contract, and you're in an uptrend, and they keep rolling and rolling and rolling, and they've maybe have these expiries smeared, and it ends up all rolling, and it's all accumulating into one monthly thing. It always happens when you get one big lump, and that big concentration of risk is also hurting your margin. When you're smearing things out, it's going to help you a little bit on your margin too, because you've got you've spread your risk out, so it's going to help. But too often people roll, and they end up finding a big conglomeration in one spot, and you want to try to avoid that. That's why it's a little tough sometimes when you're trading options and you roll a month out, and then all of a sudden that gets under pressure in 3 days. This crazy market. Well, where are you going to roll to? You've got to roll at least another month out, or 3 months, depending on what expires available, and that sucks.
It also forces you to get pinned. So it's what we call pin risk. So if you get all your risk stuck on one strike, it's called being pinned, and it's kind of what you want to avoid. And of course, if you are rolling until you're right, that age-old strategy for vol sellers, if you roll out to the monthly or worse, quarterly, you tend to find that the exchanges don't put the same granularity of strikes on the monthlies as they do on the weeklies, or on the quarterlies as they do on the monthlies. So it forces everyone to get pinned into like $5,000 buckets, and you want to try and get out of that as quick as you can. In my view, you want to. I mean, right now, in fact, you can see it on Deribit. If you look at the option metrics page, you can see that there's a massive pin risk at 50k. And at 45k, there's about 20,000 open contracts at 45k, and why aren't they at 44, 44 and a half, 45, 45 and a half? Well, it's because people got pinned at 45 when the only options were 40, 45, and 50, and 50 would have been like 5 delta, not worth selling. 45 was probably the 20 or 25 delta where everyone likes to sell, and 40 was probably 50 delta where only brave people sell, and or people who have to. And so you get that sort of pin, and it's a good idea, in my view, to, if you do find yourself there, to try and get away from the herd and spread your risk around.
It's almost, and you got to think of it this way too. So when we're trading, we take all kinds of things into consideration, all sorts of metrics. One of them, of course, being open interest. And we will look, just like everyone does in the market, at the open interest in certain areas. If you've got high open interest in certain areas, market makers do too. They're making the market. They might be short, they might be long. If everyone gets lumped into one strike and expiry, you're being hunted now. You are the prey, and you've just left a trail. Everyone knows where you are. So guess what? They're probably coming for you because everyone else is trying to hide behind the same tree. So that's why when you find yourself in this conglomerate, as soon as more expiries or more strike prices come available, you might want to distribute that risk. So you're not trying to hide behind that same tree with everyone else, if that makes sense.
So you can see here on the open interest by strike chart, I'm just rolling my mouse over the 45,000. You can see that yesterday there were 20,000 contracts, interestingly, so 3,000 have been closed overnight. But there's still 17,000 contracts outstanding there. So if dealers are long gamma, then that will act like a kind of a magnet that will tend to drag the delta hedging will tend to drive the price towards that magnet. And as it goes above, it'll tend to sell off towards 45, and as it goes below, it'll tend to buy towards 45. And there's another one here at 44, which is a bit smaller, 9,000 contracts, which is probably what we're kind of pivoting around at the moment, right? Because it tends to sell above 44 and buy below. So I'm kind of guessing that dealers are net long gamma here, and they have a lot to do with how the market's moving. Particularly yesterday, I was seeing that as we go at above 44, the funding rate went to zero, and as we came below, the funding rate came up, as if which is classic. They're selling perps and buying perps to keep the delta hedged. Of course, if dealers are short gamma around one of these open interest spikes, then as soon as that's like trying to balance a drop of oil on a convex mirror, and as soon as the market gets to the apex, it's just going to go blasting off to the side, because dealers are going to be dynamically taking futures and just driving the market through. So you tend to find in sort of mature options market these act as attractors and repellers. It's good to know who's long and who's short at these levels. It can help you a lot. But yeah, as Shane is saying, you want to try and keep your risk off these levels, because otherwise you're just going to get forced into gamma hedging or rolling or something, right? Or you're going to, if let's say you're short the 44k calls, like we are on one of our books, you're just going to be sitting there on tenterhooks all week, thinking, do I roll it? Do I hedge it? And you kind of don't want to be in that position. The only reason that we're in that position is because we're trading a $5,000 book, so we're trading in size 0.1, and we can't split that risk to smear it away. So we have other techniques for dealing with it, but it's it just adds more discomfort.
Yeah, and for anyone kind of wondering, if you think about it, if you're a market maker and you put yourself in their shoes, so they have the job to do. So they're making a market on Deribit. They're taking on risk. If the market starts to go up and people want to buy options, well, they're the ones selling them to you quite often, and they need to make a living, right? We want them to provide a nice liquid market, so they need to find ways to get paid. But as soon as they take on that short risk, they immediately have to hedge it. They don't want to let that run away and have this huge loss, right? So if they're selling those options, they're going to be buying futures to offset. So that's when we see those funding rates move, we can really see that action when people are buying more aggressively those futures contracts. I think you're bringing up the funding rate there. You can see the funding rate top left where Richard's got his mouse.
It was at 5 basis points per 8 hours earlier today. It's down to 3. I say down to 3. That's still 9 basis points a day. That's a humongous interest rate. When it was at 5 basis points a day, that was about 75% interest per year, I think.
Yeah, it's madness. I mean, obviously, it's not going to last all year doing that, because otherwise there'd be no point in trading. You just do the spread. But
I was joking with you earlier, wasn't I? That actually you get better return just by selling, mortgage your house, go buy Bitcoin, and then sell perps against it.
Sell perps. Yeah, I'm sure the bank will have no problem with that. Can you imagine trying to explain that to a banker?
Well, these days bankers are pretty gung ho, So
pretty gung ho. All right. So I hope that helps explain a little bit about smearing.
By the way, that wasn't investment advice. Just in case you're thinking of it. Oh yeah, but
Richard said to mortgage my house, and it's so perfect. All right. Good stuff. Smearing is something we can take in. So for example, if you happen to watch our live stream and we're like, hey, let's do this. Let's sell a call spread, and we look for some good value, a couple weeks out or whatever it happens to be. Well, if we see a strike we want to sell, we've already got something there. It's like, I've already got something there. Do we want to concentrate that much risk there? Mm. Can we move some things around, then put that there? Maybe we'll put it there temporarily. Maybe we'll choose a different strike. We do our best to avoid getting into that trap. I don't know if anybody does mixed martial arts. The best advice for getting out of a triangle choke is to not get into a triangle choke. Same thing here, because it's hard to get out of once you get in. So just do best to keep those things spread out, and you'll do yourself a big favor. You'll make it easier when you have to manage trades. It'll be easier when the spot price starts to threaten any of your short prices. Yeah, you'll have some there, but you won't have it all there, and it makes a big difference in, I think, your calmness and your approach to the market. So,
yeah, you can see here. I mean, we this account is only $5,000 account, so we did. I mean, here we've got 0.2 bitcoins of short, so we haven't smeared this 48k call, and that's 29th, so that's a month end. So we probably didn't have these strikes available when we broke this risk. Mm-hmm. But you see, we have smeared the cover a bit, so we're short 0.2, and we're kind of notionally long, actually. 0.2 as well, but actually we structured the cover at 60k as 0.3 at a lower price. And this isn't a great example because these strikes are $5,000 apart, but we're just trying to make sure that not all risk is on the same strikes.
No. Okay. Cool. I hope that is clear. It's a pretty simple concept, but it's very, very useful, and it's something we consider every day. Now, I just published the poll results here, and it didn't change a lot. It was 62%. I think we're going to stay in this channel until the end of the month, which is kind of interesting because I tend to agree. I think if anything was to happen, more people would jump on during maybe the holidays. They think, I better get on now. I don't know. 37% said no, we're going up before any official news comes out on the ETF, and nobody said we were going down. Not one person said we're going down. That's interesting.
I know. I think it's interesting, right? So nobody in the news thinks we're going down. Nobody here thinks we're going down. The risk reversals are 10% towards the calls in the vol surface. No one's buying puts.
I'm buying puts.
I'm buying puts too.
And I'm getting them dirt cheap. It's great. Fire sale.
Yeah.
But yeah.
Yeah. I mean, we could be wrong, but we even if we're wrong, we didn't spend much on those puts.
It was peanuts.
Right.
Absolute peanuts, and it's worth it to have because there is a case to be made for a reversal. And there's some smart cookies out there saying, no, we're going to reverse it. And maybe they're wrong.
Yeah.
I don't know who's right. I don't know where it's going to go, but I want to be prepared either way.
Can you imagine if you had a bunch of Bitcoin and you had enough that you could move markets and you just sold it into Christmas and scared the shit out of everybody? I mean, the short covering or the long covering would be epic.
It would be a spectacle. I'd cancel Christmas to trade.
You can make a film about it. The Grinch does Bitcoin.
Yeah. Perfect. Yeah. Hey, we got a quick question. We're out of time here, but we got a question from Stanislav. Thanks, Stanislav. You always have good questions. Can you share, please, where we can find free information about the gamma positions of retail and institutional traders? No. I'm just joking.
So I think is it Levitas?
I think Levitas. Yeah.
They do this. I can never remember how to spell it.
I think it's Levitas. I think.
Is it? No, it's
that's what I thought it was. I see it in my mind.
Livevitas, Laevits. I think. Let me just post this in the. I have a feeling that these guys try to get this data, and I think what they're doing is monitoring all of the trade executions that are publicly published by Deribit, and I think they assume that takers are retail and makers are market makers. So you can build up a picture of who you think is long and who you think is short at each strike and each expiry. It's not 100% accurate because sometimes market makers will take just because they need a position, but it's a reasonable approximation.
Yeah, great. Hey, I know we got a little bit of a light crew right before the holidays here, but great having everyone with us. Thank you.
I'll tell you what? We've just sold off $500.
I saw that. Yeah. So we did move down a little bit, which was kind of nice. Oh, and now Stanislav has another question. Just as I was doing my exit, but that's fine.
He's determined to keep you here, isn't
he? Yeah. How are you not afraid to sell a bunch of calls nowadays? Yeah, and a big smiley face.
Oh, dude, we laugh in the face of danger.
Yes. Well, we do it in spreads, and we will hedge with futures, and sometimes we'll just be wrong, and we'll deal with it and roll it.
Yeah. I mean, because the thing is that if you're going to double the price of a market, you've got to inject so much effing money into it that you've got to go and liquidate that money from somewhere else and persuade somebody that you can spend it and leverage up and borrow it and all the rest of it. It takes time. It takes a long time. I mean, I'm perfectly happy selling. I'm super happy selling calls into a market that's going up by 8% a month, i.e. doubling every year. That's going to make me mega money because I just stay long the underlying and sell calls and just collect all the premium. And it's kind of the same if it goes up faster, you can sell calls and sell puts and pick up the premium, and so it's never that aggressive, really. I mean, we've had a pretty aggressive move up. Just to put it into context, in November, my home savings book made 35% return. So far in December, my worst case in December, it was down 10% from the high watermark. It's currently down to 4% from the high watermark. Selling call or selling strangles basically, and staying a little bit long the underlying has absorbed that entire massive 35%, 40% rally in the underlying. Actually, it's more than that, isn't it? It's almost doubled.
Yeah, and Stanislav, I mean, I get it. You know, everybody's expected to go up. You know, it does feel like you're standing in front of a steamroller or a roller coaster or some freight train or something. When you see the high vol, it's tempting not to sell it. You just got to do so with a plan.
The thing is that everyone out there is buying it, right? Because that's why the vol is high. People are saying, I need to buy these calls. Right? And the thing is that someone is selling them those calls, mostly market makers. Now, you know, if I had to choose a side in a game of markets, I'm going to choose the market makers against the DMFs every single time, right? I'm pretty sure that what the market maker's doing is right. So I'm going to do what they do. I'm going to, if you want to buy calls, I'll sell you calls.
And let's not forget, and Rich and I were talking about this just before the call. We were having a chat when we were looking at the charts. This month of December, everybody was scared to death of us plunging down through 40K and into the 30s. Yeah. And now we're scared to death of it going the upside. Yeah. That's the life of crypto. Everybody is a bunch of lemmings from one side of the boat to the next side of the boat. And that's just the way it is. So when there's that fear, it doesn't mean you just, do stupid things. But you know what? There's a pretty good chance you're going to be okay. But you just need to be able to manage it. So you know what to do if it goes wrong, or you've got cover in place, or whatever your plan happens to be. That's how we're going to make money.
I've got a simile. It's like rock climbing. I'm not the world's greatest rock climber, and I used to be scared of heights. But I cured myself actually by being forced to go rock climbing with my son. And sometimes you get stuck in a crevice in the rock, and to go any further up, because there's a roof above you, you've got to step out around a corner and hang your arse out over the 1,000-foot drop below you, and just put your foot on a tiny ledge, and then you can start making progress up. But it's terrifying because you feel safe in the crack that you're in, and you don't want to move, and you don't want to expose yourself. And it's the same with options, right? You sometimes, to make the money, you've got to go against the herd most of the time.
I'm going to enjoy my time in the crack. All right. So, you know what? Let's wrap this up. Thank you, everyone. You know, what a great year this has been. We've had such a great crew. We get wonderful questions. And for those who celebrate Christmas, Merry Christmas. For the rest of you, Happy Holidays. For those that don't, or the Grinches, that's fine too. Enjoy your holidays. And Richard, I think we're on next week as per usual, right?
Yeah, sure. What day is that? What date is that going to be?
28th, I think, right? And next Thursday. Yeah.
Yeah. The only reason I wouldn't come is if we have a dump of fresh snow, and I'm going to be out there skiing it. But I'll do it from my mobile phone.
It's the afternoon. We do these at 3 o'clock. So if there's a dump of fresh snow, we're going to be there. Your legs will be done by 3 o'clock. So we should be okay.
Yeah. Okay.
Fantastic. Happy holidays, everyone. Seriously, it's wonderful to have you all here. And we wish you a very prosperous new year.
Okay. Cheers, guys.